Hey everybody, Daniel Char here. I'm with Rey Reyes. He was a lieutenant colonel in the U.S. Army with over 28 years of service. He's a best-selling author of the book BLUF, the bottom line up front about passively investing in multifamily properties. Rey has been actively investing in real estate since 2005, and he's led his company to investing in 10 multifamily properties in Alabama, Florida, Tennessee, totaling 401 units valued at over $28 million. So thank you so much, Rey, for joining us today.
That's my pleasure, Daniel. I appreciate it. You go by Daniel or Dan?
Daniel.
Hi, Daniel, man. It's great. I love connecting, and yeah, this is actually my first with our friends in Canada, man. So I'm excited.
Thank you. You guys had a big election over there just a couple days ago. Just wanted to see, first off, I want to tie into that in real estate, but first off, I know you said you were just retired from the military. What made you leave the military and join into real estate investing? It seems to be a very far off. Yeah, we'll start with that.
Good. Yeah, that's a good question. So, I mean, the reality is that where I was in my career, I had an option to continue on for what we would call full bird colonel, and before that opportunity was presented based on my timeline and service, I decided I wanted to retire to pursue real estate full time, specifically multifamily. And it's always been a passion of mine. Through my years in the service, I invested as I could. Obviously, I learned about multifamily a little bit towards the tail end of my career, and it was just an eye-opening experience. And I felt like I needed to do it, give 100% effort. And obviously, the higher you go up in rank in the military, the more is demanded of you. And I didn't think it was going to be feasible to do both and do them well. So I had to make a choice. I pursued my military passion for a long time. I served my country, and now it's time for me to do something else. Something else I'm passionate about.
Well, that's excellent. I'm sure everybody thanks you for your service there. Something about military men, they always do well in business. And could it be because of discipline? What is it that, like we know Robert Kiyosaki, we know Patrick Bet-David, all these big guys out there with real estate investing or business, they all have a military background. Do you think that could be a part of it?
Yeah, I think there's something to it. All right. I mean, and I've talked before about this in other spaces, because what I feel is people in the military very early on are receive that military culture, which requires you to kind of go beyond what you thought was possible. Whatever your ceiling is going in, the military grows that for you. It becomes higher, and then that experience that you've had with passing through those gates, those obstacles, help you on in life. No matter what your career in the military was, or you're doing, if you're still active military, that now you can achieve higher than what you could have achieved before by just changing the mindset, right? And so I think that's one of the key things is just there's a reason a lot of people have this paralysis analysis, right? They study, and they can't take a step. Well, the military person, in order to be successful, has to take that step, and I think that's part of the success.
Yeah, you got to make a decision whether it's right or wrong, and then you follow through figuring out what the consequence was and keep pushing, right? Perfect.
Absolutely.
Okay, so why multifamily? Like why is that the key focus that you're dealing with right now?
Yeah, sure. The biggest thing between single family and multifamily, from my experience, is that there is additional risk in single family, and the risk primarily comes from the fact that you're only one tenant, maybe two, maybe three or four, depending on what you acquire. Anything after four, it's considered multifamily. So you just don't have a lot of wiggle room when you have vacancies. And all of a sudden, what you thought were tenants paying your mortgage is you paying your mortgage because there are no tenants there for 2-3 months at a time as you kind of go through these changes. Well, having the additional scale that multifamily gives you alleviates that lack of rental income because you're spreading that risk over a lot more units. That's one of the biggest. The other one is there's just additional tax benefits on the multifamily side because you can do what's called the cost segregation study that allows you to accelerate the depreciation of that asset that would normally take you 27 and a half years here in the States. You can accelerate a lot of that depreciation within the first 5 years. And so it almost always shows a loss when in fact it has not been a true loss. And it's just very helpful, especially for passive investors that are, that have a full-time job that they get taxed on and they really need that tax break wherever they can find it.
Absolutely. So why do you, so I hear all the benefits of why people should get into multifamily. Why is it that most people invest in single family home? Like most of my clients that are investors, they start off by a very natural progression where they buy their home that they live in. And if they have a usable basement, they'll rent it out. And now they got that passive income. And then the next step, they would buy, let's say, a pre-construction condo. So they don't know how to get to the next step where it's multifamily. Why, in your opinion, why do you think most people would go for the pre-construction condos or the single family investment route?
I think it's what comes to mind when people talk, think about investing, and it's what appears to be the safest and the most attainable. So you start out, you may house hack, you buy a house and you figure you rent a room or whatever that is, whatever your story is and what model you want to use, it's pretty attainable. Now, it's not attainable for everyone because even now there's a lot of people that are being squeezed out of buying homes that have to rent.
Yeah.
And so it's not attainable for everyone, but for those that do have some ability to raise some capital or to save some money, that's what they can see in front of them. And so when you're able to kind of change your perspective and see a bigger picture, you're not limited with what's right in front of you, which, and I don't know a ton about Toronto, but there's a lot of places here in the States where even if I lived there, I wouldn't want to invest there. It doesn't make sense. It's not, it's cost prohibitive. There's a lot of reasons why it doesn't make sense. There's a lot of reasons why Californians, for example, don't invest in California. They invest in other places. So when you're
like Toronto.
Yeah. So when you open up that perspective and you see the possibilities, then it makes a lot more sense. But sometimes it takes a little bit of a leap of faith, and people, like I said, they're risk averse, and so they much rather be right next to a property which may or may not be the best investment, but they can see it, right there. And so I think that's part of it.
Yeah, in Toronto we got a lot of we got like New York pricing. So very, very expensive pricing. The attitude when people were investing in Toronto, not so much now because of the whole COVID. And so we have a down market right now, downtown Toronto. But pre-COVID, it was, I want to buy something for $700,000 pre-construction. And I hope in 5 years it's going to be worth 900. I hope it's, and most of these investors got lucky for the last 10 years. But when you look at the numbers, as in right now, they are cash flow negative. Now, even if you do put a tenant in there, you still got the mortgage, you still got the taxes, you still got the maintenance fees. And then what we realize is that these guys are shelling out about $1,000 or $1,200 out of their own pocket to help somebody else live there, right? So the numbers don't work. But I understand, like, if you want to live there, makes sense. But if you want to invest, you got to look at the cash flow to make sense from day one. So what are your pricing like in your area? Like what can somebody find as a multifamily asset?
Yeah, that's a good question. So it depends on where you're looking, right? So I'm in multiple markets in the States.
Mm-hmm.
I'll talk a little bit about my market here. I'm in Orlando, Florida, and of course we get a lot of Canadians come down.
Yeah.
New Yorkers come down this way, and a lot of them invest here, and they're snowbirds, and so there's not a bad connection already, and so people kind of understand this. In Tampa, where I've done a lot of my acquisitions in Florida, a couple of years ago we were looking at mid 60s for a price per unit. And that's one way to sort of gauge it, right? There's other things you got to look at, cap rates, et cetera. But ultimately it boils down to how much are you paying per unit. And so between that, that time period and just 4 months later, when we closed on that asset, the prices have gone up by about 12, 13 grand. I mean, literally, just like that, just the demand shifted, cap rates squeezed a little bit, and all of a sudden price has gone up. Now, what was 68, 70 grand is now over 100,000. And we're talking 3 years, right? So, so that's about what you're seeing right now in a lot of markets. It's about in the major markets, right? 100,000 a unit or so. If you buy something that's really old, then maybe you get it for a little bit cheaper. If you buy in a tertiary market, for example, not in a huge metro, but somewhere, in the vicinity or even a little bit further away, then those price per units go down accordingly. So as you know, Daniel, really the real estate market is very local. So you have to study your particular market for it to make sense, because in California, you can't buy anything for less than, let's say, 300,000. That buys you very little, right? The little studio. Yep. And I could be wrong. It could be a little bit more. It could be a little bit less. But it's a significant difference from where I'm at here. And so it's all based on some perspective. But I think you hit the nail on the head that it's about the cash flow. We got in trouble in this country in 2008 because people were buying with this expectation of appreciation. It wasn't buying because you were getting a return on your money right away. It was because you expected that at some point in the future you could sell and double your money, and you haven't done a thing, a couple years. And so that doesn't last forever, and where we are today, that's not the market. So what investors should be looking at is, how do I make money today? Because if you can make money today, you can duplicate that effort later because you got positive cash flow coming in. And then you do still see appreciation because real estate, for the most part, always increases in value. At the very least, it keeps up with inflation, and a lot of places it actually beats inflation. So you're getting cash flow now, and that's the key, because you don't want to be in a position where you're red every month, because eventually you run out of money to be able to do that. And it's not fun. It's like, okay, well, yeah, you can write that off, but it still costs you more to lose that money than otherwise. It's better to write off, a huge chunk and still make money, which is what the multifamily model allows you to do.
Yeah, that's absolutely the case. So you want to look for cash flowing properties, making money from day one, have all your rents covered, and you got some money in your pocket. The question now is, who would sell you that property? So I know you mentioned that you bought a property and it went up in value because it's appreciating. Why would somebody sell you a winner? Like, they got a winning ticket right now. Why would they let that go?
There's a lot of reasons. For one, a lot of investors, as they have their natural progression, you talked about a progression from, smaller single family to buying multiple single family, et cetera. Investors sometimes do the same thing. Multifamily investors, they start out, they buy a 50 unit. They may even buy something smaller than that, 70 unit. And all of a sudden they're looking at 100 plus units. And so in order to do that, a lot of times they start getting rid of some of their lower unit inventory. And so that's one reason. Another reason is a lot of people bought these properties and they're not professional, investors. They could be mom and pop investors that bought it years ago. You talk about a property, a C-class property in the 1970s, they probably bought it very cheap, and there's no real incentive for them to raise rents to market because they're already making enough. It's probably better for them to not raise the rents than have to deal with some of the additional work that comes with having to move a tenant if you're the property manager. Obviously, we bring in a professional property management team. That's what they do because they're maximizing the rents. But if you've owned this property for years, that may not be a motivation for you anymore.
Yeah, so it might be that they want to cash out. They bought in very cheap, or they know that they got to put in more money for maintenance, and they just want to not deal with that in the future. So you come in and you take that problem off their hands. Okay.
Yeah, the other reason is sometimes for example, if you're doing a value add project, which is very similar to a fix and flip for the single family folks out there. But you take an older apartment that has deferred maintenance and you're fixing it, and you're raising the rents to market. You're not trying to raise it above market, but at least to market.
Yeah.
And so what you do is, instead of rehabbing all of the units, you rehab a portion of those units, you bring those to market, and then you can then sell that property to another investor that wants a stabilized asset that they can keep longer term. So what would take, in a value add project, you may hold it for 3 to 5 years. You can then sell that to a stabilized investor or somebody that's looking for long term, and you can then basically pitch them like, hey, you already know that if you fix these other units, you're going to be able to raise rents because we've proven that in our model, right? And so then they can take that, do the final piece of that rehab, and then they can hold on to that property for long term. So that's another strategy when you're acquiring something and you're using the value add model. Sometimes you just want to get in, raise the rents. That automatically raises the sales price, and then you get out, and then you can step up to something bigger, or maybe to a higher class asset. For example, instead of a C, you can move on to a B class asset, which is newer. Will have less maintenance that you have to worry about.
Okay. And what do you look for when you're, what is your main priority when you're looking for a property? Is it the location? Is it the price? The numbers, like the cash flow?
Good question. So before I start looking at properties, I like to focus on some of the macro items that are really important. So I call it the big 3+R. I want to see a growing population.
Okay.
I want to see a growing employment sector, or lower unemployment, depending on how you look at that. And then I want to see an overall growing economy. They can be interrelated, but they're not exactly the same thing, and they don't necessarily fall along the same timeline, although they can be parallel, right? So it's 3 things that you want to look at. You want to see good trends there. Now, the thing that you also want to look at is you want to take a look at that market, that general market. You want to evaluate the risk. And the risk that I'm talking about comes from 2 primary sources. One, you obviously don't want to rent in at least in the States. There are certain states that states within the union here that you don't want to invest because they are so pro-renter that, they're so skewed towards
That's like Canada.
The renter that, you are really risking a lot, because, if that renter decides that, they can't pay, they don't pay, or they can't pay, it is a real problem to move them out. And if this is, although we want to help people, we want to give them good places to live, it's a business. This is a business. So you don't want to put yourself in a place that then if you have problems with tenants, that you can't move them on and get quality tenants in there. So that's one risk. The other risk, and this is more local, is crime. You want to take a look at a downward trend in violent crime. And so, and a lot of these resources are available free. You just have to go in there, because you're not looking at what happened yesterday, which is where you start getting into a lot of paid services. You're looking at longer terms. You can do a Google search and get some of this information. I have a YouTube video. I have a YouTube page. Maybe I'll give it to you after this, where
Absolutely.
You can post where I show people where they can get this information for free. And so that then they can pick those markets, 3-4 markets that they're comfortable with. And then you look at properties that make sense, because what you don't want to do is pick a nice property that has downward trends, macro trends, because no matter how good you are as an operator, as an investor, you're swimming against the current. It's just a lot harder to make it work.
Yeah. So I just want to recap. So that, so you want increase in population, low unemployment, low crime rate. And what was the last one?
And growing economy.
Growing economy. Okay.
And then, of course, the political situation and the crime as far as.
Let's talk about that. So actually, before we go political, I want to know how did COVID affect multifamily investing? Like I mentioned to you earlier, in Toronto, it affected the condo market in the hub, but it doesn't mean that the whole real estate market's down. Like our suburbs, the outskirts, they're just on fire now. We're seeing like these properties that went for 300, now it's going for 4 or 5. Like they're going multiples, but the condo market is a little down. How has that affected you guys in multifamily?
Yeah, great question. And it really is a local phenomenon because I'm currently in a deal where we're raising capital, and I can't go into it obviously because it's a 506B. Without going into technicalities, I can't advertise that
Yeah,
deal.
no worries.
But the, in that deal or in that place, we had 4% rent growth during COVID. This is again one of those tertiary markets. It was close enough to a large metro that it really gained that extra oomph that you needed because the metro started suffering. So people were moving from these large metros where there no longer does it make sense to be in an apartment building with 500 other people in a 12, 13 story unit that you can't leave the house, right? And then you leave the apartment and it's so tiny. So people were looking for these outlets to go into bigger spaces. And so that's what I mean, it's local. So it just depends on where. I mean, overall, multifamily saw a little bit of a dip, but not much, because the other phenomenon that we have in this country is you have a lack of housing supply. So that is a lot different than where we were in 2008, where there was just an abundance of supply and not enough people looking for housing. Yeah. We still had, before we came into this situation with COVID, an under supply and higher demand. You have the seniors, but you also have a large demographic group, which is the millennials and then the Generation Z, that are all moving in now, moving out and looking for places to live. And guess what? A lot of them don't make enough money to buy a house, so they're renting, and they want to live sometimes, and they don't want to buy. They just want to rent. So those dynamics really help the multifamily market overall to kind of be fairly level. And so it wasn't too bad. Now, where there was some hits is in cities, especially that had a large population of tourism. Obviously, that hurt those economies. Mm-hmm. But what we didn't see, even in those cities, for example, in Orlando here, we didn't see a drop in prices because the people that are buying properties are not the people that are working, generally speaking, in those lower level jobs that suffered from the tourism issues and some of these issues. So it's why you get this, what's called that phenomenon, a K economy, where you have, a portion of the population that continued to work, that was able to transition from the office to the home, and they're still doing very well. But you do have a population, a piece of the population that suffered. So I would say if you were in a C-class asset, an older asset, which is where you have your blue collar renters, they suffered a little bit more, but not as much as people think. You still have over 90% occupancy in a lot of these, especially in assets that had professional property management. I think where there was a little bit more, churn was in these smaller assets that people are trying to manage for themselves because they didn't have the expertise to help people that were, that lost a job. They couldn't help them find COVID resources that became available, the financial resources that became available. And for a lot of reasons, they basically weren't helping themselves get some income to replace some of that income they weren't getting from those workers that were no longer working.
Do you foresee that, let's say the lockdown stop, do you see the market move back to where it used to be, or do you think this is here to stay?
Yeah, good question. I think you're going to have it just depends because it's very regional, like I said. If your economy is very diversified, your metro or your MSA, like we call it here, if that asset is, that population has diversified economy and opportunities for work, it's going to do a lot better than an economy that does have a larger, pool of people in tourism. So it just depends. But I think we're going to see, people, one thing I've seen is people have kind of gotten tired of the lockdowns, and some states here, since a lot of it is kind of managed by states, they've had some flexibility about how to work through this pandemic as far as, with the businesses. And so I saw the other day, it was you had a ton of people that were already, in Universal Studios in Orlando. Of course, somebody took a picture of them or a video of them with their mask and like complaining that those people were really close together. But my thought was like, if those people are doing that now and they're assuming that risk, they know there's risk. They have their mask, and a lot of them do. Then I can just imagine when this vaccine sort of kicks in a little bit more, that's going to really, improve things a lot. I think the international travel is going to be a little bit slower coming in, particularly, if you got to get on a, if you got to come, from say Europe or someplace like that. I think that's a lot trickier and harder from a tourism standpoint. But for example, Canada and Mexico, where people can, they're obviously different rules. I think those people are going to, be coming here a lot sooner than that. Yeah. So overall, I think a good feeling going forward here.
Good. I want to touch base on on the political side. So I noticed that there's a lot of articles right now with people leaving California. They're going, leaving blue states, going to red states, like tech giants and all. They're going to Texas. They're going to Florida. Do you expect a big boom in residential multifamily because of that, or do you think they're just moving the companies and people are still going to work remotely at home?
Good question. I think you will see a shift in that. Now, there's also this discussion of at some point in the future, people kind of going back to some of those metros. It's possible, but I think if you're a millennial or your Generation Z, you're going to be getting in a phase of your life where you have children and you want space, and you're going to be thinking about the fact that maybe there's another pandemic coming someday, and I don't want to be stuck in a little apartment, And so I think some of that's going to stay, and the phenomenon of being able to work from home. I think what you'll see is probably a morphing of that, where people will be required to maybe go to the office once or twice a week, and then they can work from home for a portion of that. I think you'll see a lot of that in places where you do need sometimes that personal connection, that contact to be able to do things. Some will never go back to that, but the beauty about investing in multifamily is you don't necessarily have to be where you want to invest. And I keep going to that because that's the most important thing. You want to invest where you're going to get the best cash flow, the best return on your money. And that doesn't necessarily have to be right next to you. And in fact, if you have a job or if you're doing something else, the last thing you want to do is worry about being a landlord, worry about having to manage a property. You want to have, that's the other thing multifamily does is it has a layer that's called an asset manager, and asset management that manages the property manager. So if you're an investor, you don't get the call that you would potentially get if you were a landlord and you had your property manager calling you about some expense. There's already some layer looking at your money and looking at that as the focus of how they look at this investment, right? At this asset. The property manager is worried about keeping it filled. The asset management is looking at the returns and what's the best return that they can provide to investors.
So even people out of state can invest, people out of the country, like even Canadians can invest with you guys too.
Absolutely.
Right? Yeah.
Absolutely. We do. We have
people true passive investing.
Through passive investing. Absolutely. Yeah. We definitely have that. And even if it's, I'm one of the things that from my background and my ability to speak Spanish, I'm broadening out and working with people in Latin America and Mexico and other places, also bringing them in and being able to invest in the U.S. And all it takes is you just have to create an LLC here. You don't have to be a citizen to do that. And so there are definite ways you can invest your money, even if you're not from, the preferred partners, Canada, Mexico at this point.
Mm-hmm. Okay. And in regards to, I know we mentioned like we had a crazy election just recently. Do you think there would have any play who's in power, whether it's a Democrat or Republican? Does that have anything to do with the rules that they put in place or any of the laws or taxations that would affect investors?
Yeah, good question. And who knows exactly what's going to shake out. What I know is that, obviously we've moved a little bit left, and so what that means is generally that usually helps lower income people. So in a situation where we are now, where people in those lower income classes need additional money, this is probably a good thing over the short term. Now, what worries some people is that there's going to be more of this dynamic where, you know, now it's going to become harder to invest or to be in business because you're giving away more of your money to others that some feel haven't earned it, right? It just depends on where you sit on that scale. I would say that, you know, the one thing that is good for me, and when I think about this, is that Congress is relatively split down the middle between red and blue. Yes, it's leaning a little bit blue, but in order to pass things in this country, you really need more than just a straight majority. And you can't always count on people that are Republican to vote on the Republican side, and vice versa, because they have to answer to their states. And so it's not going to be as simple where, you know, everything is so skewed to one side that, you know, that everything's going to change from one group or the other, depending on which side you stand on a lot of these issues.
Mm-hmm. So would you say that would be like if somebody wants to make a decision and right now they're a little nervous because they don't know what's going to happen, it could swing right or left, should they wait or should they do the math right now, call you and you can present all the facts and then make a decision?
Yeah, so that's always a tough question, right? And I have this discussion with investors all the time. They, you know, especially this time of year where a lot of people are doing New Year's resolutions and they're reflecting back on what they did last year. And you know, a lot of them were, you know, they had plans that they were going to do all these things and they don't do them. And so now they're going back in another year. I'm like, listen, you cannot keep waiting for the perfect opportunity. Those don't exist. And so you have to work with what you've got, and you have to make the best of what you got. And you know, I'd say that, for example, for the last 3 or 4 years, people had been expecting this depression or recession to happen. Right? We'd been in the longest economic prosperity period in this country, bull market, and it was just going and going and going. And what turned it, obviously, the black swan was COVID.
Yeah.
But there's been people that have not invested their money for 3 or 4 years, waiting for this perfect golden opportunity. But real estate, I keep saying it, is local. Just because something is going on nationally doesn't mean it's going to impact investments locally or regionally. And on top of that, in this investment, this is not something that you can do without. You need a place to live. Yeah. People have to live somewhere. So you can't, it's not like they can choose not to live under a roof. I guess some people don't have a choice, unfortunately, but most people, the majority of people, 99%, some, you know, plus, live under a roof. And that means that there is going to be a continuing demand for this.
And I also think, just to piggyback off of what you said, is I think there's going to be an attitude shift now going towards physical assets. Because in the last couple of years, it was all stocks were on fire, Bitcoin, digital assets are on fire. But we know how much money is being printed right now. And I think that there's a fear that the money that you're making or saving is not going to be worth as much. And you want to dump it into something physical where you can touch and feel it. And whether it's multifamily, whether it's a condo, but you have a house that you can call yours. Or you can call, you have a rental income in there, and that would offset some of the risk of inflation.
Correct. Some people have, and I have, you know, wealthier investors that have a portfolio and they basically look at it in percentages. And what I would say is what they do in many cases is they diversify so that they hedge against some of their investments. And some of them have a lot in the stock market. Some of them have alternate, you know, investments such as Bitcoin and other things. And those will also have a portion of their assets that are sitting in real estate. So it's not all, sometimes it's not all or nothing. Sometimes you just want to hedge a little bit. You know, if, or maybe you don't, but the idea is you definitely have to look at some of this artificiality in the economy when you can just, like you said, print money. You know, I mean, I still sometimes just wonder, like, I can still remember, you know, when gas was, you know, 99 cents, You know, and it hasn't been, I mean, it's in the 80s, it's been a while, but now you look at it and you know, on a good day, you can get, you know, 250 or 220, depending on where you're at, or higher. And what's changed? I mean, it's not, yes, supply matters to some extent, but really what's changed is inflation.
Yeah.
And it's the same thing with housing. Housing, you know, you could buy a house back in the day for, you know, $80,000, and a nice home for a family. You know, nowadays you need 300,000. I mean, that's about, you
And
know,
everybody accepted that, right? Everybody accepted a car costs 20 grand, a house costs 300 plus, gas costs X amount. So, and I think we're adapting to that additional cost now.
and they keep going up. I
Yeah.
mean, I just, like I mentioned, I mean, some place like here where I'm at nearby, you're having 5 to 10% growth in prices of homes in 1 year. And it's just crazy because I mean, a lot of people can't afford that, so they have to rent.
Yeah.
It's just a crazy world right now.
It is. It is. Well, thank you so much, Ray. Do you have any last words for our viewers? I really enjoyed this interview here.
Only thing is, if anybody wants to reach out to me, the best way is through my website, mirealestate.us, mirealestate.us. I'm happy to get on a call. I do that all the time, and just to get if you got some specific questions, or obviously if we connect, then I can actually start sending some of the investments that I have available to me. So it just depends.
Absolutely. Thank you so much, Ray. I'm going to put Ray's contact information in the description below, and also a link to buy his book on Amazon. Thank you so much.